Hello and welcome to the 2019 Dynamic Directions Bullish on Business video series. We have some great videos planned for you throughout the year, starting with today's around your investment department and your investment lineup, your portfolios for your clients. We're going to highlight one of the very best advisors in the entire industry, D2 investment guru Drew Watson. And we're going to see what he's doing in his practice so you can find out firsthand exactly how he's running portfolios for his clients in his practice. Now, this is a guide for you to learn from. If there's things that you can copy, go for it. But it's really critically important that you have your process in place. Each of you are different. Your practice is unique. Your clients are unique. And your offering, your portfolios need to suit the needs of your clients. So always be putting yourself in your client's shoes. What do they need from you in their portfolio management? In the last 2 or 3 months, we've certainly gotten some tests, stress tests on portfolios as we face some volatility. And it's good learning to know, is that going to get your clients to what they need? Can they sustain the volatility? Can they go through possibly a multi-year cycle of some downturns after 10 and a half years of significant upturns? Will they be okay? And I think delivering a small number of portfolios that suit most of your top clients is really key to this industry. If you look at your people, your top clients, there's probably a lot of similarities. And the needs of a lot of your people are probably similar. So if you have similar solutions that can help multiple clients, it's a lot easier to run a format where you're managing a small number of solutions for people instead of having thousands of individual accounts that are impossible to keep up with. I think the mistake that a lot of advisors make earlier in their careers is they individualize each portfolio for each client, even each account, and it ends up with hundreds and hundreds and hundreds of different positions, different funds, different ETFs. Advisor can't keep up with all these different positions. Then you've got all these different types of accounts with different allocations, and as you see clients, you adjust them, and it's really an erratic way to do business, and it's very tough to keep up with all these portfolios. The danger in that is, what if something's going on in a client's life and you can't communicate with them in a timely manner? Maybe they have a year, they just can't talk to you. You know what? That's a big danger in the portfolios. If they've got something that was customized, a year ago, you're not able to talk to them. So getting something that works for many, and you being able to manage it, a small number of things, small number of portfolios that work for most of your clients, that's really critical here. A great best practice that you can derive from. As you see, Drew's a pretty advanced practice. He's got his starting lineup to relate it to a sports team. He has his starter players. He's got his bench backup players that he can use and utilize for portfolios. He's got a lot of samples on his spreadsheet, how he pulls from his list of players, his funds, his ETFs, how he arranges them for clients. And you'll see very clearly for his biggest top clients, there's lots of holdings, and it's simplified as he goes down in the smaller clients. So have good portfolios, but it's much less number of holdings. So as you approach your portfolios for your clients, build the biggest and the best for your best clients. Make sure they have all of your offerings. Everything in your arsenal, all of your firepower is being built for them. Then you can just pare down to the different tiers. The next tier can get the diet version, the slim down version, the simplified version as you go down to your smaller clients. So make sure you're in order. It's a great time of year. We'll have 2 of these videos a year to really uncover your investment department. It's a big part of doing business. It's one of your largest revenue sources. For most practice, it's the largest revenue source, managing money. So let's get this one right. Let's make sure your process is in place. Your portfolios and your starting lineup of players is in place. And more importantly, whatever decision making is going to happen throughout the year, let's get this in place now. You don't want to be caught in a position where you're making a decision based on some emotional feeling that, oh my gosh, things are going down. They said on CNBC they're going to get worse. I'm going to do something in my portfolios now. I mean, if that's the way you want to manage, that's okay, but you've got to be ready to be on call and your team to be on call constantly, because I mean, look at the end of December. We had a lot of down days in a row right after Christmas, huge up day. I mean, the market is moving very quickly, faster than ever, and we've got to be in place to capture these ups and downs. Is just the reality of where we're at. So make sure that your management style is going to fit your clients in how you conduct business. You don't want to be caught constantly trading and creating a lot of work for yourself and for your team. You want to make sure that you've got a process that doesn't get you caught in the trap of any emotional decision making, or decision making influenced more by feeling and less by logic. You want to build some logic based decision making in advance and know exactly how you're going to handle different things that will occur in the markets. Let's face it, we don't know what's going to happen, but we know something will happen. So the certainty of uncertainty is a great term that's been slung around. The only thing we can be certain about is that we're uncertain what will happen. So we've got to be prepared, and having the right portfolios, the right process is so critical. So get your process built. We look forward to your upcoming coaching sessions. I'd love diving into this part with advisors. So let me know, let your coach know how we can help you get your process, your portfolios in place to suit your client needs and to help boost the biggest part of your business, managing money. So it's a great time when we're going through volatility. Make sure you're in extra contact with clients. You don't want them to feel uncomfortable. That uncertainty of should I be worried, and not being able to talk to their advisor, not hearing from them, that's one of the reasons that clients leave. That black cloud of uncertainty, you don't want that hanging over your relationship with your clients, because that will drive them to leave. Look, life's been pretty easy the last 10 and a half years. I mean, markets have been pretty good. Clients haven't had a lot of reason to leave, even if, they haven't heard from their advisor in a long time. My accounts are doing pretty good. This is not so bad. The second they go down, they think, well, what am I paying for? Have I heard from this person? Do I have that cloud of angst or anxiety over our relationship? And if it's there, downturns are motivators to leave. So make sure you're building a moat around your clients and you're talking to them. But let's go on offense. This is the greatest time to capture new clients, when there is volatility and they get their statement and they see that, oh my gosh, things are down. I'm not hearing from my advisor. So play defense, talk to your clients more offense, but go after it. This is the greatest time to acquire clients. People need you. Their current advisor of your prospects probably isn't talking to their clients. They're probably scared under their desk. They don't want to pick up the phone. They don't want to talk to them, or they don't have a process in place to service clients like you do. So go after it. Get to those new people. Leverage your clients that you're talking to. Gosh, I'm so glad we can talk at these volatile times. I bet you have friends, family that aren't hearing from their advisor. Let me know. We can help them. So looking forward to hearing about your results. Stay bullish. Let's make 2019 the best year yet. We'll talk to you soon in your upcoming coaching sessions. Take care.
Hello, D2, and welcome to the first Bullish on Business webinar for 2019. You don't have to say anything. I know. I look great. You can tell I've been losing weight and living healthy. Look, I'm down to just 2 chins. And we're here to discuss our investment lineup for 2019. We appreciate you joining us on this Bullish on Business segment. And we'll start with the main differences and things that you'll probably notice as you go through our investments. Number one, on the fixed income side, we've really abandoned credit type investments in favor of the highest quality funds, indexes, and or straight treasury bills from the U.S. government. Specifically speaking, you'll see a few of the Lord Abbett products, inflation protected funds, ultra short bonds, also those types of products from Putnam and Federated, to mention a few. On the investment side, you'll see a little bit of an allocation to international markets, primarily with the Developing Markets Fund, as well as international small cap. We are really big believers in international small cap investing, as the data continues to show that if you're going to be invested internationally, that the risk return profile for small cap stocks far exceed those of their larger ADRs. Finally, on the U.S. front, you'll see a tilt towards quality types of investments away from just an all-out growth allocation that we had overweighted for most of 2018. Our growth index in general has been the VUG from Vanguard, but you'll see additional players this year, such as the Principal Blue Chip Fund. You'll also see the Qual and Momentum indexes from iShares, as well as continued investments in Vanguard and the RDVY product. In the small cap space, we've continued to use the Delaware product for small cap coverage, as well as specific sectors where we've overweighted, such as the Aerospace and Defense Index, symbol ITA. Finally, in our larger accounts, we do like the Virtus Wealth Masters Fund as a somewhat non-correlated equity product, as the premise of this product is to have holdings where the owner of the company is still very active and has really have a lot of skin in the game compared to just basically for-hire CEOs, so to speak. And that has a decent sized mid-cap coverage as well. Specifically speaking, what you'll notice is we have continued to have a decent weighting in energy in all of our models. We've been a believer in oil prices, even though that didn't pan out last year. And we have a good weighting in gold, either the GLD index or actually Newmont for our larger accounts that people want individual stock exposure. So as you go through the spreadsheets, you'll see those investments. And if you have any questions, please feel free to reach out to us at our offices as we can kind of go over what our thought process is. In the big picture, what we're hoping for in 2019 is, as we have more volatility, that more of the volatility is up than down. Specifically speaking, we are also hopeful that financial issues will perform better than they did in 2018, and you'll see where we haven't abandoned the positions we've had there primarily. We have already taken profits in healthcare as it continued to be kind of a stalwart performer both in 18 and the beginning of this year, and moved into more quality type positions. And even we've doubled the utility exposure in some of our models as well, either with individual stocks or indexes that cover that sector. For the time being, as I opened with, you'll see us with the highest quality fixed income positions and an underweight to international. Well, we all feel like Londoners during the Blitz of 1940 as we emerged from December's market sell-off to the sun of a new January. Specifically speaking, it looks like stocks have started the year off fairly well. Some areas are still in a technical bear market pattern, but other areas have seen a pretty good risk-on trade year to date. Specifically speaking, later on what you're going to see is our new investment spreadsheets with different ideas we have for 2019 that we put into place towards the end of 2018. But by and large, what we're focusing on now in the markets is one, what's going to go on with interest rates, and it looks like we have kind of an all-clear signal from the Fed. Two, what will happen with U.S.-Chinese trade relations. And the last thing that we need, I think, to go well is one of two things need to happen. Either one, the Chinese need to have a stimulus plan, which it looks like they might, or the U.S. itself have some type of infrastructure plan put in place sometime later this year. Given the government shutdown, and I think we're 31 days into it, it appears that may be a long shot at this point, but it still bears worth watching. Specifically speaking, year to date, energy shares have done very well. If you stayed in your larger oil producers or the energy index as a whole, you've done well for your clients. Specifically speaking, MLPs, which are very good higher yielding investments, have had an exciting start to the year, and most indexes approaching double-digit returns. Other areas that have really done well this year include real estate. The main real estate investment we use has seen returns of close to 7% year to date, and that's after a very good year in 2018. 2018 appears to be a good year for what I would call our exotic types of investments, depending if you use an Alrock product, Terra, or some of the non-traded REITs. They tended to all finish the year in positive territory compared to negative performance from most stock indexes. What we're looking at going forward in 2019 is one, we're hoping to see some U.S. dollar weakness, and on any U.S. dollar weakness that would be prolonged, you would want to consider probably a re-entry into the developing markets if you exited those last year due to volatility. Traditionally, when the U.S. dollar is weaker, those emerging markets economies do quite well. So that's one area that we're watching. Secondarily, we're also looking at the factor investing between quality stocks, dividend aristocrats, and momentum stocks. Up until the end of last year, it was all about momentum all the time. Some of the big names like Amazon and Facebook, I'm sure you're familiar with. And to get coverage there that would be fairly easy to use, you could look at either the MTUM index, another index for quality stocks. A good iShare proxy is the QUAL, the QUAL. We use quite a bit of the Principal Blue Chip Fund itself. And then there's also the Vanguard indexes, VIG, VUG, as well if you're an indexer. Specifically speaking, one of the items that we've noticed is if you go through the laundry list of stocks that didn't work out last year, you're going to find most blue chip names. I think a best practice would be going through these with clients, and they do understand that historically, if they've owned Johnson & Johnson, Chevron, Exxon, Prudential, JP Morgan, in any given year, they're all down 8 to 20%, they are a little bit more forgiving and understanding that those companies probably are not going to go out of business, and they want to continue to hold their blue chip positions. You can do this on an individual side, or also potentially utilizing the top holdings of any type of fund or ETF that you are utilizing. What you'll see in our investment spreadsheets is that we have overweighted to cash type of investments. Specifically speaking, with our larger clients, we've used actual U.S. Treasury bills, typically the 90-day vintage, nothing exceeding 2 years on our fixed income, and a lot of Treasury type funds held up well as we've exited credit pretty much in most all of our models. The other area that you'll see that we're continuing to look at is staying in high quality tech names. Even though Apple had a sell off as well as Google, we've remained loyal to those. We do feel like cash flow at the end of the day is king, and we'll continue monitoring those situations. On the consumer staples side, we continue to invest in Clorox, Johnson & Johnson, those types of blue chip companies, and you'll find those in the QAL index or the VIG Vanguard index. We are explaining to clients that we expect volatility to continue, and as well as how the government shutdown affects economics. No one really knows, as we are probably now into the longest government shutdown in history, but I'm sure that will not be a tailwind at some point this year whenever it does come through the government factors. Another item to discuss with clients is how weird the tax return will look. This is a copy of the new 2018 return. If you print this up, you may think your copier didn't work correctly, but this is the 1040 form, and it's never a bad idea on the financial planning side of things to walk clients through the new look of it, especially those that prepare either all or part of their taxes themselves, to let them know the changes that will be made. Good hunting, and hope you have a wonderful day in D2.